When you start doing business in Denmark, understanding value-added tax, or VAT, is critical to operating smoothly and avoiding costly surprises. In this video, we will walk through the fundamentals of Danish VAT, how it works in practice, and what you should pay attention to whether you are a local entrepreneur, an international company expanding into the Danish market, or a freelancer providing services across borders. Let's begin with the basics. VAT in Denmark is a general consumption tax applied to most goods and services at a standard rate of 25%, one of the highest in the European Union. Unlike some other EU countries, Denmark does not apply reduced VAT rates for specific goods such as food, books, or transport. In principle, 25% is the flat rate you can assume unless a transaction is explicitly exempt. VAT is governed by Danish law, but the framework is aligned with EU VAT directives, meaning that if you are familiar with VAT in other EU countries, you will recognize many of the concepts, though the details and local practices can differ. The starting point for any business is determining whether you are required to register for VAT. In Denmark, if you carry out taxable supplies of goods or services as a business, you must generally register when your turnover exceeds a relatively low threshold, which is set by the Danish tax agency and may change over time. In practice, many businesses choose to register from the moment they begin commercial activity, because registration allows you to deduct input VAT on your costs. If you are a foreign company selling goods or services in Denmark, you may also need to register locally, especially if you store goods in Denmark or provide services that are taxed where the customer is located. There are specific rules for distance sales, e-commerce, and digital services, including the EU's one-stop shop regime, which can simplify compliance if you sell to consumers in multiple EU countries. Once you are registered, you must charge VAT on your taxable supplies. This is referred to as output VAT. At the same time, you can usually deduct the VAT you pay on goods and services purchased for your business, known as input VAT. The net amount, output VAT minus input VAT, is what you pay to the Danish tax agency. If your input VAT exceeds your output VAT in a given period, you may be entitled to a refund. It is important to understand that not all supplies are treated the same way. Some activities are exempt from VAT in Denmark, such as certain financial services, healthcare, education, and cultural services. Exempt means that you do not charge VAT to your customers, but it also usually means you cannot recover the input VAT on related costs, which can make these activities more expensive from a tax perspective. There are also specific rules for mixed activities, where a business has both taxable and exempt supplies, requiring an allocation of input VAT between deductible and non-deductible portions. From a practical standpoint, compliance revolves around correct invoicing, accurate accounting, and timely reporting. Danish VAT invoices must contain specific information, including your VAT number, the customer's details, the date, a clear description of the goods or services, the price, and the VAT amount or the applicable rate. For intra-EU supplies of goods and certain services to businesses, additional documentation and reporting apply, including EU sales listings. Periodic VAT returns are typically filed monthly, quarterly, or semi-annually, depending on the size of your business and your turnover. Deadlines are strict, and late filings or payments can trigger interest and penalties. Many companies in Denmark use accounting software integrated with the online systems of the Danish tax agency to streamline reporting and reduce the risk of manual errors. When dealing with cross-border transactions, VAT becomes more complex, and this is particularly relevant in Denmark, which trades extensively with other Nordic and EU countries. For business-to-business supplies within the EU, the reverse charge mechanism often applies, meaning the customer accounts for VAT in their own country instead of the supplier charging local Danish VAT. For exports of goods outside the EU, the supply is typically zero-rated in Denmark, which means you do not charge VAT, but you can still deduct related input VAT, provided you have appropriate documentation proving that the goods left the EU. For imports into Denmark, import VAT is usually due at the border, although simplification schemes may be available, and you may be able to recover this VAT through your regular VAT return. E-commerce businesses should pay special attention to the rules introduced under the EU VAT e-commerce package, including the import one-stop shop for low-value goods sold to EU consumers, which can significantly affect how and where VAT is collected. Beyond the technical rules, there are some practical considerations that are essential if you want to manage VAT risk effectively in Denmark. First, invest in robust processes and internal controls. Clear procedures for reviewing invoices, coding transactions, and validating VAT numbers for EU customers can prevent small errors from turning into significant exposures over time. Second, maintain thorough documentation. In the event of a VAT audit, the Danish tax agency will expect you to provide invoices, contracts, shipping documents, and correspondence that support your VAT treatment. Third, stay informed about legislative changes and administrative guidance. VAT rules evolve, especially around digital services, sustainability-related incentives, and cross-border trade, and what was correct 3 years ago may not be accurate today. If you are part of a group of companies, consider whether Danish VAT group registration is relevant, as it can allow multiple legal entities to be treated as a single VAT entity for Danish purposes, simplifying internal charging and cash flow. Finally, if your activities are complex, for example, if you operate in highly regulated sectors like finance, healthcare, or energy, or if you are designing new digital platforms, seeking specialist advice can be highly valuable. A tailored VAT review may identify opportunities to optimize your VAT position, as well as areas where you face hidden risks. To summarize, VAT in Denmark is built on a straightforward framework, a single standard rate, clear registration requirements, and alignment with EU principles. But the details, especially for exemptions and cross-border transactions, can be nuanced. Ensuring that you register at the right time, charge VAT correctly, maximize your input VAT recovery, and meet all reporting obligations is central to operating compliantly and efficiently in the Danish market. By establishing strong processes, leveraging technology, and seeking expert input where needed, you can manage VAT not just as a compliance obligation, but as an integrated part of your financial and operational strategy in Denmark.